Welcome back, everyone. So, if you deal with corporate finance, you already know that untangling a company's balance sheet can be, well, an absolute nightmare. Today, we're bringing you a brand new explainer tackling a highly technical yet absolutely essential SAP FICO topic, the down payment cycle. Whether you're prepping for a massive interview or just trying to figure out exactly where the money went, we're going to break this down so it actually makes sense and, more importantly, so it actually sticks. Our roadmap today actually comes straight from the Complete Preparation Guide by FICO consultant Sharad Mishra. And honestly, what I love about this source is that it goes way beyond just memorizing a bunch of T-codes. It arms you with real consultant-level architecture that applies seamlessly to both SAP ECC 6 and S/4HANA. Okay, let's dive right into this. Just imagine your business needs to pay a vendor before they've actually delivered the goods or services. It happens all the time, right? But here is the fundamental accounting problem. How do you handle that advance payment without completely breaking your balance sheet? Because if you just dump it into your normal payables, your financial reports are going to tell a wildly inaccurate story. And trust me, your auditors are going to have a field day with that. To solve that whole mess, here's our agenda for this explainer. First up, we'll look at the special G/L solution. Second, the outgoing cycle. Third, the incoming cycle. And finally, we'll wrap up with some integration and advanced scenarios. All right, section 1, the special GL solution. Because, understanding the why is absolutely crucial before we just start memorizing the how. To fix that balance sheet problem we just talked about, SAP uses this genuinely brilliant mechanism called a special GL transaction. Specifically, we use type A, which just stands for advance. When a down payment is posted, this indicator acts kind of like a giant detour sign. It tells the system to completely bypass the normal reconciliation GL account and instead direct the posting to a highly specialized alternative GL account. Think about it. If you post an advance to the standard reconciliation account, the system automatically nets out your payables and receivables. That creates a distorted figure that totally hides your true liabilities. But by routing it to a special GL account, like an advances to vendors account, finance gets pristine, completely separate reports. Your trade liabilities stay totally accurate, and your advances are tracked clearly as assets. It's a total game changer. Moving right along to section 2, the outgoing down payment cycle. Let's actually look at the workflow when we're sending money out the door to a vendor. Now, before any end user can even think about posting a down payment, a consultant has to set up the plumbing. And that brings us to a massively important configuration checkpoint, T-code OBYR. This is where the magic mapping happens. You take the standard AP reconciliation account, which is designated by account type K for vendor, and you link it with that special GL indicator A. You are explicitly telling SAP, hey, whenever you see K and A together, route that money directly to the advances to vendors GL. This is literally the foundational map for the entire outgoing cycle. So let's track the actual chronological journey of a single dollar through this setup. It kicks off with a request using F47. Now remember, this is purely statistical. No actual money moves yet. Next, the actual cash leaves the building via F48 or an automatic payment run. Down the line, the vendor finally delivers and sends the actual invoice, which gets posted via FB60. And here is the vital part. T-code F54 clears the down payment. It moves that advance out of the special GL so it can apply against the normal invoice. Finally, F53 pays whatever residual balance happens to be left over. Now, if you're sitting in an interview for a SAP FICO role anytime soon, you are almost guaranteed to get this classic gotcha question. Can you actually pay a down payment request, which we just established is a purely statistical informational item, using the automatic payment program F110? And the expert answer is yes, absolutely you can. Actually, that's exactly why we create the F47 request in the very first place. But there is a trick to it. In your F110 parameters, you have to navigate over to the Free Selection tab. Right there, you specifically select Special GL Transactions and input Indicator A. This explicit instruction basically tells the system to reach out, grab those purely statistical F47 requests, and pull them directly into the actual automated payment run. Okay, section 3, the incoming down payment cycle. Let's totally flip the script over to Accounts Receivable. Now, what's really interesting about this is, well, if you understood the AP flow, you are absolutely going to love this, because SAP uses this mirroring technique that literally cuts your cognitive load in half. The accounts receivable cycle functionally mirrors the AP cycle. It's just viewed from the customer's perspective. So the mapping T-code flips from OBYR to OBXR. The account type changes from K to D. The exact same underlying logic applies, you're just wearing a slightly different set of T-code hats. Because of that mirroring, stepping through the AR flow is a total breeze. We start by creating the statistical request for the customer in F37. Once their cash actually hits our bank account, it's posted via F29 to the customer's special GL. Later on, we deliver the goods and bill them normally. Then, F39 clears that advance, moving it cleanly over to the normal AR account. That leaves the customer to just pay whatever the remaining balance is using F28. Simple, mirrored, and elegant. And finally, Section 4, Integration and Advanced Scenarios. This right here is what separates a novice from a true, seasoned FICO consultant. The absolute crucial point here is understanding exactly how SAP protects you from making, well, catastrophic accounting errors. And it does this through a very strict clearing hierarchy. If multiple down payments exist, SAP looks at them in a highly specific order. It recognizes down payment requests first, then noted items, and finally actual down payments. The foundational logic here is all about security. The system strictly ensures that only actual, legally posted funds, like real cash, can ever be cleared against open invoices. There is simply no way you can accidentally clear a statistical request against a real bill. Another really advanced integration point is withholding tax, or WHT. If you have this active for payment time posting, things get super interesting. When you pay that initial advance, SAP automatically calculates and deducts the withholding tax right there and there. But what happens later when you pay the final invoice? Wow, SAP is actually smart enough to do a full recalculation at the final clearing stage. It automatically adjusts for the tax you already deducted, ensuring your vendor is never hit with double taxation. It is an absolute lifesaver. Let's anchor all of this theory we've been talking about with a very specific real-world scenario. Let's say you have a single, long-term project purchase order worth exactly $1,000. It's a big project, right? And the vendor demands milestone payments along the way. How on earth do you track all of that cleanly in SAP? So here is your consultant-level solution for that. You definitely do not try to mash it all together. Instead, you create multiple, separate F47 statistical requests against that single PO. Let's say one for $100, one for $200, and maybe one for $300, and you tie each one to a specific milestone due date. When those dates arrive, you just execute your separate payment runs in F110. The system elegantly selects each specific F47 request and posts it as a distinct, separate F48 down payment. The absolute beauty here is the traceability. Every single advance is tracked cleanly and independently against that one single $1,000 purchase order. We've covered a lot of ground today: the core architecture, the mirrored AP and AR cycles, the whole shebang. So I'll leave you with this provocative thought. Could you confidently map the journey of a single dollar through the special GL in your next interview or project meeting? With the structured logic we've laid out today, I am betting the answer is a resounding yes. Thank you so much for joining us on this explainer. Keep reviewing these concepts, and we'll see you next time for more focused learning.